It's a package where everybody wins, right? The founder gets cheaper capital. Their existing investors like it as well because they're not getting diluted further either. And oftentimes it helps de-risk them because they want to see their companies be successful. And the more money the company has, the higher the probability of success. But sometimes the VCs don't have any more money to put into the company, right? So they're out of cash, or maybe they're not out of cash, but they've allocated all they're going to this particular company. But then the debt financing, provides the company with additional capital, de-risks it further, and the existing equity holders don't get diluted any further. So they like it. And then, of course, the investors into the venture debt fund, like our investors, for instance, like it because they're getting a relatively safe return that's kicking off, 15 to 18% cash yield plus equity upside, which historically has been worth about 5% annualized as well. Yeah. So actually, one thing I should mention from the investor's perspective that's nice is these loans are all floating rate. And so in this environment where rates keep going up, it's one of the few credit products that's actually outperformed and not lost money. In fact, the coupon's gone up roughly 4% because prime rate has increased almost 4% in the last 9 months or so. And that's really attractive. So you've got two ways that this product hedges interest rate increases. One is the floating rate. The other is these equity warrants that are typically 10-year expiries. And what's nice about warrants is it's essentially a call option on the company's stock, right? And one of the best long-term hedges for inflation is long-dated call options. Because as inflation increases, it pushes up the value of everything, the price of everything, right? As the price of everything increases, the price of your call option is going to increase, and the value of your call option is going to increase. So it's one of the few fixed income products out there that doesn't actually have any interest rate risk. On the fixed income side, what I like best is either floating rate that you mentioned, or more of a barbell portfolio where you've got front end, short duration liquid treasuries that are still yielding, a nice 4% or so. And then when the opportunities present themselves, you sell those treasuries easily and roll into, better opportunities. So I think it's good to have some dry powder and good to have some liquidity, but you don't want to have too much cash sitting there because inflation's eating away at it. And that's where it's a tough market, right? We could be in a stagflationary type environment coming up. I mean, I think we already are, but it could get a lot worse. And that's where it's tough because people say, hey, sit in cash until there's an opportunity. But if it's getting eaten away at 10% a year, that's rough. I mean, you can't really hold cash for too long. Your performance is going to get decimated. So that's why I think it's good to think about opportunities where you can generate a solid return, and they need not always be liquid if you've got liquidity in other parts of your portfolio. So the portfolio construction I really like is liquid
America,
treasuries
without a college degree. Everybody's got to go to college.
And then some alternative exposure, private debt and other private assets that kick off a higher yield. And a lot of those products will have floating rates. So think direct middle market loans, venture debt, some traditional leverage loans or bank loans. And then there's other interesting products out there like infrastructure debt, real estate debt. But I think debt's not a bad place to be, provided you're not in too many fixed rate coupons, right? And you've got a big chunk of that in variable rate debt. I'll map out the competitive landscape. So there's basically two markets. There's the bank funding market, right? And there's the non-bank lenders. So on the bank side, Silicon Valley Bank is the biggest by orders of magnitude. And historically, they've had market share that was probably 2/3 of the market. It's less today, but it's still probably at least half the market.
Right.
And there's other banks as well, like Bridge Bank is a big venture lender. Comerica has historically been a big venture lender. And those are really the big three. There's others that do it on the margin, but not in a material fashion. It's really just SVB and the others to a lesser extent.
5% to 80% of the market.
Yeah. And then on the non-bank side, there's there's a couple large publicly traded business development companies that are NASDAQ traded. And the biggest is Hercules. They've been around as a public stock, I think, since 2005.
Yeah.
And there's a couple others that have been around for a number of years as well. Triple Point and Horizon have been publicly traded for quite a while. And there's a couple of recent entries to the space as well, Runway Growth Capital and Trinity Capital. So those are the 5 publicly traded NASDAQ BDCs that specialize in venture debt. And what's nice about the BDCs, from my perspective and from any investor's perspective, is they're required by the SEC to report details on every loan they've made. So I've looked back at every loan that Hercules has made and the others have made to 2005 and scrubbed that data, so I know exactly where every deal has priced in that market. So when I talk about numbers, I'm not throwing out numbers that can't be validated. These are straight numbers out of SEC filings. And what the big takeaway is that going back to 2005, the average debt yield aggregated across all the public BDCs has been 15% with very little volatility. It's wrapped around 15% every single year. And the warrant positions are harder to calculate because some of them haven't even been monetized yet. But on average, the warrant positions are worth about 5% annualized. So in the non-bank market, we know that the returns are about 20% per year. What's great about the venture debt market is it's relatively insulated from rate increases. In fact, we actually benefit as a lender from rate increases. As prime rate and SOFR have increased, as base rates have increased, the cash coupon has increased in lockstep. And all of these loans, or the majority, I should say, pay on a monthly basis. So there's very little risk when rates go up because the coupon adjusts upward. So it's nice to be in that part of the market. And then because of the warrants that we get, that hedges against longer term inflation as well.
Yeah, well, and I've been preaching this to investors for decades now, that floating rate bonds or adjustable rate bonds aren't well known in the economy and the market, because we've been in a declining interest rate environment for most of current investors' lives. Mm-hmm. And so now only in the last year we've been raising rates, and people don't know what to do about it. But floating rate and adjustable rate bonds, whether it be other types of corporate adjustables or venture, could be a great place to be.
Yeah, and that's a great point, Brian. For our entire lives, essentially, as investors, rates have been going down. So why would you want floating? You're getting paid less every year. And now it's the exact opposite. And so it's requiring an adjustment in thinking. It's been a paradigm shift, right? And I think it's what I'm noticing is it's taking some people longer to adjust to it than others. A lot of people are still anchored to their prior views because that was the world they lived in for so long. The last 13 years, we had a raging bull market. So imagine you came out of college in 2010, all you've seen is up and to the right in terms of performance. And so every time the market went down in the last 13 years and you bought the dip, you were winning, right? Yeah. Now it's the exact opposite, in my view. Now you buy you think you're buying the dip and you're just trying to catch a falling knife, right? Right. And so that's where I think we're going to have to see people kind of adjust their thinking quickly, or they're going to get hit pretty hard.